Millions of Americans are about to wake up to a nightmare. 2 million cars, rental returns, repossessions, and lease vehicles are about to flood the market, and the prices? They're crashing fast. Buyers who thought they made a smart investment just months ago are now underwater, paying $700 a month on cars worth far less than what they owe. The used car bubble isn't slowing down, it's collapsing, and the question is, who's going to survive when the dust settles? If you are someone who has been waiting to own an affordable sedan or a mid-size SUV without having to pay thousands of dollars over the sticker price, you might sympathize with the recent shock in the used car market. It seems like everything has gone too far, and looking back at what has happened since 2020, the picture is far from simple. In 2020, when new car factories struggled due to chip shortages and supply chain disruptions, new car production dropped sharply, creating an unusually limited supply of used cars. According to Business Insider, the average price of a 3-year-old used car in the U.S. increased from over $22,000 before 2020 to over $31,000 by 2025. A significant jump, isn't it? The shortage of new cars seems to have extended into the following years, as the average age of trade-in vehicles in the U.S. rose to 7.6 years in early 2025, the highest level since 2019, according to AP News. This means fewer nearly new cars are returning to the market, and individual buyers are competing in a market where supply seems constantly tight. Moreover, the price frenzy seems to have made things look even crazier. Sedans or SUVs that once cost tens of thousands of dollars are now being pushed even higher due to fierce competition and squeezed supply. The Mannheim Used Vehicle Value Index surged during this period, as if the market was playing a game that individual buyers could only watch. Perhaps a large portion of buyers got caught up in this whirlwind because credit was too easy to obtain. Low post-pandemic interest rates made car loans attractive, and many people accepted 7-year loans even though their actual ability to pay remained uncertain. When interest rates rose again, borrowing costs also went up, and this seems to have left buyers with little choice but to bear the financial pressure. Additionally, the media and many dealerships seem to have given the green light for large loans, making individual buyers prone to negative equity, owing more than the actual value of their vehicles. The feeling of losing control when your loan is higher than the value of the car you just bought is probably something many have experienced. We also cannot overlook the role of the big players. During the pandemic years, and even afterward, rental fleet companies and lease return programs seem to have adjusted their operations, resulting in fewer cars returning to the market than expected. Cars that could have reached individual buyers were instead held back or sold slowly to optimize prices, making affordable supply increasingly scarce. Automakers and finance companies also seem to have played a sophisticated game, limiting new car supply or holding back leased cars to push individual buyers into fierce competition. According to multiple sources, fewer lease returns have helped shrink the supply of used cars, and many rental fleets appear to deliberately hold vehicles back to optimize profits. Combining all these factors, the used car market seems to have become a picture of artificially inflated prices. Used car prices tend to rise sharply, turning vehicles that were meant for transportation into speculative assets. When prices are pushed up and then demand weakens due to economic hardship or rising interest rates, individual buyers become vulnerable. Many seem to be paying loans higher than the actual value of their cars, and the feeling of buying a car like buying a lottery ticket doesn't seem too far from reality. Inflated prices also create false expectations. Many people think used cars will hold their value, but in reality, they depreciate quickly when the market turns, leading to widespread negative equity, a situation no one wants to face, yet seems hard to avoid. Have you ever thought that buying a used car was a safer investment than buying a new one? If so, you might find that recent reality feels a bit harsh. It seems that what has happened in the used car market over the past few years is turning many buyers into involuntary victims of the price frenzy. After the 2020-2023 bubble period, many used models seem to be losing value at a staggering pace. A 2023 Ford F-250, once praised as a symbol of strength and durability, dropped from $64,000 to around $51,000 in just a few months, a loss of $10,000 to $15,000. It's not just pickups. Familiar sedans like the Honda Accord or Toyota Camry also seem unable to escape this fate. According to many sources, the prices of these models dropped 30 to 40% in just 2 to 3 years, giving many everyday buyers the feeling that the market is throwing smoke bombs at them. It seems this depreciation doesn't discriminate by vehicle class, from economy cars to luxury models, forcing many families to watch the value of their assets vanish quickly, while increasing the risk of falling into debt that exceeds the vehicle's actual worth. As prices plunge, quite a few buyers seem to fall into negative equity, meaning the loans exceed the actual value of the car. The direct consequence is a tightening of household budgets. You might want to sell or trade in your car to free up cash, but it seems that's not really possible. The original loan still needs to be paid in full, bringing persistent financial pressure. Many people appear to experience the feeling of being stuck in a depreciating car, directly affecting their ability to spend on other needs like travel, home repairs, or even retirement plans that had been long scheduled. During the bubble period, many seemed to hope that used cars would hold their value or even increase, a small comfort amid widespread economic difficulties. In reality, prices fell rapidly, turning temporary gains into long-term burdens. Striking example is a Ford F-250 purchased for $64,000, which was worth only $51,000 just months later. The buyer still had to pay the original loan, losing $13,000 immediately. This situation is not uncommon with lease returns or repossessed cars. Many buyers who entered the market at high prices seem to have only accumulated additional financial stress. It appears that the recent bubble not only drained money, but also transformed the temporary joy of buying a car into a prolonged burden. Millions of Americans, from everyday cars to SUVs, are facing direct and long-lasting effects. The impact is not only financial, but also psychological: stress, reduced spending, and effects on family or work plans. Vehicles once seen as a convenient solution now appear to have become headaches both financially and mentally, leaving many to wonder whether the joy of owning a new car is really worth the cost. If you once thought used car dealerships were safe harbors amid the storm of rising car prices, you might need to reconsider. It seems that what is happening in the market is not just about individual buyer debt, but also a hidden tsunami shaking the dealerships themselves. It appears that every car in a dealer's inventory is not truly free, as people might think. Most are financed through floor plan financing, a type of loan to maintain inventory without immediate cash payment, but daily interest costs are far from light, about $22 to $45 per car per day. As inventory rises and sales slow, the picture worsens. An average dealership holds about 200 cars. That equals daily interest costs of roughly $6,000 or $180,000 per month. It seems that many dealers have no choice but to sell at a loss to reduce interest pressure, resulting in negative profits and sometimes substantial losses. The risk of closure also seems to loom over many dealerships. According to multiple sources, about 25% of used car dealerships could cease operations within the next 12 months. The cause seems to be a perfect storm of rapidly falling car prices, high floor plan interest costs, and slow demand due to tight credit. The social consequences are probably significant. Sales staff, mechanics, and service teams may lose their jobs, and many families will face new financial pressure from lost income, directly affecting local communities. The domino effect in the market also seems to be occurring quietly but alarmingly. When a dealer cannot repay a floor plan loan, cars are repossessed and pushed to auction. This sudden influx of vehicles into the market appears to push prices even lower, putting pressure on other dealers. The cycle repeats. Dealer sells at a loss. Cars go to auction. Prices fall further. Debt pressure rises. More dealers close. It makes the entire used car market extremely unstable, and many people will likely find it difficult to predict prices in the near future. The direct impact on individual buyers also seems quite serious. Rising inventory but falling prices make it difficult for dealers to guarantee quality service and warranties. People living in rural areas or small towns will likely face transportation deserts, where buying, trading, or repairing cars becomes more difficult. The result is reduced mobility, directly affecting work, study, and daily life. The market becomes tense, unpredictable, and probably erodes buyer confidence, while surviving dealers must operate in a high-risk and unprecedentedly stressful environment. It seems that all of this paints a picture that many industry insiders and car buyers did not anticipate. The used car market is no longer a safe haven, but rather a hidden battlefield where only those who are truly cautious and resourceful can survive. It seems that the used electric vehicle (EV) market is facing an undercurrent that many traditional car buyers may not have fully noticed, or perhaps have chosen to ignore. Apparently, tax policies and incentives designed to encourage EV adoption, especially during 2022-2025, inadvertently created what some are calling a lease loophole, leading to a surge in leased EVs. Nearly 1 million EVs were leased from early 2022 to the first quarter of 2025 alone, and it seems that these vehicles will soon start flowing back into the market. For individual buyers, this sudden spike in supply could mean difficult choices, unexpected competition, and, in many cases, the potential for rapid depreciation that might make a once promising investment feel a little less promising. Adding another layer of pressure, the expiration of EV tax incentives at the end of September 2025 seems poised to trigger a wave of returns. Lessees who no longer benefit from tax credits appear increasingly likely to hand their vehicles back when their contracts end. This scenario is shaping up as a second wave of EV lease returns, threatening to send shockwaves through an already volatile used car market. Buyers who were counting on stable prices might be in for an unpleasant surprise, and dealers could find themselves juggling both an excess of inventory and the challenge of pricing vehicles realistically. The numbers projected for this return wave are nothing short of staggering. Forecasts suggest around 123,000 leased EVs will re-enter the market in 2025, 329,000 in 2026, and a whopping 650,000 in 2027. Over 1 million used EVs in just 3 short years. Some sources report that EV lease returns could rise more than 230% in 2026 compared to the previous year, fueled by the large number of leases executed between 2022 and 2024. This influx of vehicles is likely to place enormous pressure on the used car market, forcing buyers, both new and experienced, to proceed with caution, reevaluate their expectations, and think twice before making impulsive decisions. It also appears that the value of used EVs is declining faster than that of traditional internal combustion vehicles, something many EV buyers may not have anticipated. Pre-owned EVs could be 20 to 30% cheaper than their original sale prices, reflecting both the sudden surge in supply and lingering concerns over battery technology and lifespan. The potential cost of replacing or refurbishing a battery looms large in the minds of prospective buyers, creating a sense of uncertainty that drives depreciation even faster. In a way, the very incentives that once made leasing an EV seem like a financially savvy move are now transforming into long-term risk, particularly for those who financed their purchases. This pressure doesn't appear to be confined to the EV market alone. As used EVs flood the market, the overall supply of vehicles is likely to expand, seemingly putting downward pressure on prices for traditional cars as well. The combination of a tidal wave of EV lease returns and softening prices for internal combustion vehicles may be contributing to what looks like a highly unstable used car market. Timing plays a crucial role here. The expiration of earlier leases could generate a big wave of returns that forces both buyers and dealerships to brace for an uncertain, tense, and highly volatile period. It seems likely that even seasoned buyers, those who thought they had seen it all in previous market cycles, may be surprised by how fast conditions can change. Yet, it does not appear that all of this is necessarily bad news for buyers. For those with the ability to pay in cash, this could be a rare opportunity to purchase a nearly new EV at a far more reasonable price than before, potentially turning market turbulence into a personal advantage. However, the familiar caveat remains. For buyers financing their vehicles, the risk of negative equity continues to loom large. If prices continue to fall after purchase, the same kind of financial squeeze that affected traditional car buyers during the last price bubble could occur, turning what seemed like a smart decision into a source of stress and frustration. You see, The used EV market is entering a period where opportunity and risk seem to coexist in almost equal measure. Those who plan carefully consider total ownership costs and remain alert to both market trends and the timing of lease expirations may be able to benefit. For others, however, the coming years may reveal how quickly a seemingly promising vehicle investment can transform into a cautionary tale about timing, supply, and the subtle hazards of incentives gone awry. For those thinking about buying a car right now, it seems that patience might be more valuable than haste. The market for used vehicles, especially 3-year-old models, continues to hover at elevated price levels, with averages exceeding $31,000 in Q3 2025. Inventory sits longer on dealer lots than many buyers might expect, and sales are moving slowly. Taken together, these signals suggest that price volatility is far from over, and anyone rushing into a purchase may find themselves caught in the crossfire of a market still adjusting to past distortions. It appears that those who can pay in cash may be in a somewhat safer position. They could avoid the twin hazards of negative equity, where the loan exceeds the car's actual value, and rising interest costs that can quickly turn what seems like a manageable monthly payment into a significant strain on the household budget. Buyers depending on financing, however, may find themselves navigating a financial tightrope, where a slight drop in car value or a change in interest rates can have a much larger impact on their day-to-day financial security. Some industry experts seem to suggest that if a car isn't urgently needed, it may be wiser to wait. Watching the market for a more attractive price could allow buyers to secure a nearly new used vehicle at a more reasonable cost, but only if they approach the process with a clear eye on the car's real value rather than its sticker price or the hype surrounding it. For dealers, the outlook seems no less challenging. Those who have been able to pivot quickly, shifting focus toward high-demand value vehicles, hybrids, or models tailored to what buyers actually want, may have managed to sustain sales and even avoid losses in a volatile market. Yet, holding inventory for too long while prices continue to swing appears to be a perilous strategy. Capital gets locked up, deep discounts or even outright losses may become unavoidable, and profit margins can shrink to the point where survival itself feels uncertain. It seems that dealers who can identify and dominate niche segments, affordable vehicles, hybrids, or models that precisely match buyer preferences, may be the ones best positioned to weather the storm and continue attracting customers, while those clinging to outdated strategies risk being left behind. The challenges stretch beyond individual buyers and dealers. High prices for used cars, slow inventory turnover, and pressure from financing constraints are limiting access to vehicles for a large swath of consumers. Buyers searching for cars under $15,000 may find themselves forced to wait longer, settle for less desirable models, or make compromises they hadn't planned for. High interest rates on auto loans compound the problem, making borrowing less attractive and creating a subtle drag on mobility. People may be forced to rethink how they commute, whether they can maintain multiple jobs, or even how they manage day-to-day errands, schooling, or family responsibilities. If prices don't soften at the pace some expect, these effects could linger, exerting a deep, prolonged impact on household finances and overall quality of life. In short, it seems this is a time when both buyers and dealers must brace themselves mentally and develop long-term strategies rather than hoping for a sudden market recovery. For buyers, this may mean exercising patience, waiting for a more favorable price point, or leaning toward cash purchases to minimize exposure to negative equity and rising financing costs. For dealers, it may require adjusting inventory, focusing on high-demand or hybrid vehicles, and staying agile with pricing decisions. And for the market as a whole, keeping a close eye on credit availability, regulatory policies, and broader macroeconomic factors may be the only way to anticipate the next shift in an environment that remains highly unpredictable. In this context, thoughtful planning and a long-term perspective seem to be the only tools available for reducing risk and positioning oneself to seize opportunities once the market eventually stabilizes. It seems the used car market is facing an unprecedented wave. About 2 million cars are about to flood the market. Prices appear set to plummet. Individual buyers will suffer. Dealers struggle to survive, and the entire system is becoming more unstable than ever. This pressure is not just numbers on paper. It directly affects finances, mobility choices, and the mindset of buyers, as well as dealership operators. For those considering buying a car, every decision now must be made with extreme caution. And for dealers, this may be the biggest test ever of their ability to survive in a volatile market. If you're thinking about buying a used car or an EV at this time, do you plan to wait for prices to drop or risk buying now? Share your perspective in the comments below. Lastly, notice that the content in this video is based on publicly available information, vehicle manuals, and automotive studies. It is intended for educational and informational purposes only, not to promote any specific brand or product. Viewers should always cross-check information, follow manufacturer recommendations, and make their own informed decisions when it comes to vehicle maintenance. Thanks for watching, and see you in the next video.